Hey everyone, welcome to Alpha Insights. I'm Archer, and today we're digging into a bill that could change how US cannabis companies access capital. And hey, if you have questions while you're listening, drop them at stockalpha.ai.
And I'm Lucy. We're looking at proposed legislation that would let major US exchanges list cannabis-related businesses under a federal safe harbor. Big potential implications for markets, liquidity, and valuations.
So, the real question here is what happens if these US cannabis operators can finally list on the New York exchanges? Right now, many of the big names, Green Thumb Industries, Trulieve, Curaleaf, are mostly trading on over-the-counter venues or on Canadian exchanges.
Exactly. That structure keeps a lot of institutional money on the sidelines. Pension funds, mutual funds, index funds, large asset managers. Many of them simply can't buy over-the-counter stocks, so access is restricted.
Which has downstream effects. Liquidity stays low, bid-ask spreads stay wide, and valuation multiples are depressed. Analysts note US cannabis companies often trade at about 4 to 8 times EBITDA, while comparable consumer and healthcare peers trade closer to 12 to 25 times.
Yeah, that's a good point. The gap isn't always about operations. It's structural. So if uplisting happens, it doesn't magically change cash flow, but it does make these stocks investable for a whole new class of buyers.
Which is why people talk about multiple expansion. If some companies re-rate from roughly 6 times EBITDA to 12 times, valuations could effectively double without any operational improvement. That kind of repricing has happened in other sectors when they became index eligible or otherwise institutionally accessible.
And it's not just price multiples. Trading dynamics would likely shift. Exchange-listed securities tend to have tighter spreads, higher volumes, and deeper order books. That reduces volatility and improves price discovery. And it lowers the cost of raising capital for companies.
Lower cost capital matters a lot in this industry. It's still capital intensive. Expansion, labs, retail footprint, compliance. More efficient financing could accelerate consolidation and improve margins over time.
There's also the short squeeze angle. Today, many cannabis names are thinly traded, heavily shorted, and retail heavy. Uplisting brings in institutional bids and professional market makers. As demand grows and float turns over, short positions might get squeezed, which could amplify moves.
But we should be realistic about risks. Legislative timing is uncertain, and the details matter. This safe harbor doesn't legalize cannabis at the federal level. It just makes listing possible. Exchanges still have standards, and regulators will be watching compliance closely.
Right. Not every company would benefit equally. Larger, vertically integrated operators with solid compliance, cleaner balance sheets, and near-positive cash flow are the most likely winners. Smaller firms with weak finances or regulatory exposure could struggle to qualify or to attract institutional interest.
And for those wanting exposure now, one of the more liquid ways has been the AdvisorShares Pure US Cannabis ETF, known as MSOS. But ETFs can mask dispersion. Some individual names are still underfollowed and under-owned.
There's also execution risk. Even if the bill advances, exchanges will set listing rules, and market participants will pass which companies qualify. Banking reform or federal rescheduling could be separate steps that change the picture even more.
Honestly, I was a bit surprised by how much of the valuation gap looks tied to market structure rather than operations. This is more about legitimacy and access than product market fit in many cases.
Yeah, to add to that, investors and analysts will be watching a few things closely. Which companies meet exchange standards, how quickly institutional allocations happen, and whether consolidation accelerates once financing gets cheaper.
Short reactions?
Interesting.
Right. Okay, time to wrap up. Key takeaway 1. Allowing uplisting would remove a major structural barrier, institutional access, and that alone could meaningfully re-rate parts of the sector.
Key takeaway 2. Uplisting would likely improve liquidity and lower the cost of capital, which supports expansion and consolidation, but benefits will be uneven across companies.
Key takeaway 3. Execution risk matters. Legislative timelines, exchange rules, and broader banking or rescheduling changes will all shape the outcome. Analysts note this is a potential inflection point, not a guarantee.
For informational purposes only, this is market analysis, not investment advice. If you want to dig deeper or ask us questions, we'd love to hear from you.
Got questions? Head over to stockalpha.ai, where you can ask us anything and we'll answer live. And while you're there, check out more market content. Thanks for listening.